Welcome to Section 6 of the ASC 505 Equity Training Series for PNJ Group. This section brings together every equity transaction we have studied and shows you exactly how to record it in a journal entry. We then step back and look at how stockholders' equity appears on the balance sheet and what disclosures are required. By the end of this section, you will have a complete toolkit for both recording and presenting equity. After completing this section, you will be able to record journal entries for issuing common and preferred stock, apply the cost method correctly when treasury stock is purchased and reissued at various prices, record all three dividend types, handle preferred stock conversions and retained earnings appropriations, and present the equity section on the balance sheet in the required order with all mandated disclosures. When a company issues stock for cash, the entry splits proceeds between the par value component and the excess. Debit cash for the full amount received. Credit common stock, or preferred stock, for the number of shares times the par value per share. Credit a PIC, common, or a PIC, preferred for the remainder. There is never a gain or loss on a stock issuance. It is purely an equity transaction. Keeping the APIC accounts labeled by class matters when preferred stock is later converted to common, as we will see. Under the cost method, the most common approach on the exam, treasury stock is recorded at the price actually paid to repurchase the shares. Debit treasury stock and credit cash for the full purchase price. Treasury stock is a contra equity account, so total stockholders' equity falls by the repurchase price. The par value of the shares is irrelevant at this stage. You are simply recording what you paid. That cost basis stays in treasury stock until the shares are either reissued or formally retired. When treasury shares are reissued for more than they cost, the entry is clean. Debit cash for the full proceeds. Credit treasury stock for the original cost you paid. The difference, the excess of proceeds over cost, goes to credit a PIC treasury stock. This excess is never income. It is always equity. Over time, a PIC treasury stock accumulates a credit balance from multiple above-cost reissuances, and that balance becomes a buffer you will need when reissuing below cost. Below-cost reissuance is where candidates make errors. Debit cash for the proceeds, which are less than the cost. Credit treasury stock for the original cost. The shortfall must be charged somewhere, and the sequence matters. First, debit a PIC treasury stock to use whatever credit balance exists there. If that account is fully used up, then debit retained earnings for any remaining shortfall. The shortfall never goes to the income statement as a loss. This is a fundamental principle. Equity transactions do not generate income statement gains or losses. Cash dividends require two separate journal entries. At the declaration date, debit retained earnings and credit dividends payable. This is the moment equity decreases, the declaration date, not the payment date. Between declaration and payment, dividends payable sits as a current liability on the balance sheet. At the payment date, debit dividends payable and credit cash, clearing the liability. Dividends are never an expense on the income statement. They are a distribution of equity, which is why they reduce retained earnings directly. A small stock dividend is defined as less than 20 to 25% of outstanding shares, because the distribution is small enough that the market price is not expected to drop proportionally. It is recorded at fair value. In our example, 1,000 shares with a fair value of $18 and a par of $1 debit retained earnings for $18,000, which is 1,000 times the $18 fair value. Credit common stock for $1,000, the par amount, and credit a PIC for $17,000, the excess of fair value over par. Retained earnings falls. Common stock and a PIC both rise. No net equity change. Large stock dividends, generally 25% or more of outstanding shares, use par value, not fair value, because the issuance is large enough that market price is expected to drop proportionally. In our example of 10,000 shares at a $1 par, debit retained earnings 10,000 and credit common stock 10,000. There is no APIC entry. The contrast with small stock dividends is stark. Small uses fair value and splits between common stock and a PIC. Large uses par value only, and the full debit and credit are the same number. When preferred stockholders convert their shares to common under a contractual right, the accounting uses the book value method. Debit preferred stock for its par value, and debit a PIC, preferred for the entire a PIC balance associated with those preferred shares. On the credit side, credit common stock for the par value of the new common shares issued and credit a PIC, common for whatever is left over, the residual. No gain or loss is recognized. Total equity does not change. It is purely a reclassification from preferred components to common components within equity. The balance sheet equity section follows a prescribed order. Start with preferred stock at par, then common stock at par, then a PIC which may be presented in one line or broken out by class. Next comes retained earnings, followed by a OCI which may be positive or negative. Finally, treasury stock is presented as a reduction labeled less treasury stock because it is a contra-equity account. This order is the standard you will see on every public company balance sheet and every exam simulation. Not every preferred stock sits in permanent equity. If preferred stock is redeemable at the holder's option or upon a contingent event outside the issuer's control, it is classified in the mezzanine, the section between total liabilities and permanent stockholders' equity. It is labeled temporary equity or redeemable preferred stock. If the redemption is mandatory, meaning the issuer is required to redeem it, the instrument is actually a liability, not equity at all. The key question is always who controls the redemption and whether it is certain to occur. Several disclosures are mandatory regardless of whether amounts are material. Dividends per share must appear either on the face of the income statement or in the notes, never omitted. Share data, authorized, issued, and outstanding, must be disclosed for every class of stock, typically on the face of the balance sheet or in notes. The rights and preferences of preferred stock require description. Retained earnings restrictions from appropriations or covenants must be explained. And as we covered in Section 5, the statement of changes in stockholders' equity is itself a required presentation. Here are the 5 ideas to carry forward from this section. Stock issuances always split between par and a PIC. Proceeds are never income. When treasury stock is reissued below cost, drain a PIC treasury stock first before touching retained earnings. Small stock dividends use fair value and hit a PIC. Large stock dividends use par value only. Preferred conversions are book value transfers. No gain, no loss, no income statement impact. And the equity section of the balance sheet follows a required order with mandated share disclosures. Thank you for completing this section on journal entries and financial statement presentation. Thank you for watching. Subscribe for more training from PNJ Group.